Picture this. Someone you know just crossed $25,000 saved. It took them 4 years, and within 8 months, they're staring at $4,000, wondering where it all went. Or maybe that someone is you. Here's the crazy part. Stacking the $25,000 wasn't the hardest step. That was repetition and restraint. The real danger shows up in the first 72 hours after you hit that milestone, when your brain starts murmuring that you've earned an upgrade, that it's finally time to stop living like a broke student. That whisper is the line between retiring with $2 million and clocking in at 70. Today, we're breaking down the most fragile point in your financial life, the moment right after you finally save something meaningful. Because no one explains this. When you reach $25,000, only 2 outcomes follow. You either turn it into roughly $400,000 over 30 years, or you burn it trying to look successful. And the pivot happens in the next 14 days. Your brain craves certainty. Markets deliver volatility. Your brain wants reward now. Wealth demands patience measured in decades. Most people don't fail here because they're stupid. They fail because they're battling hardwired psychology. So let's walk through what actually works, starting with one blunt question. Do you carry high-interest debt? Credit cards, personal loans, anything charging above 6-7%? If you've got $12,000 on a card at 24% interest, you are not investing. You're extinguishing that balance first. Here's why. Owe $12,000 at 24% and make minimum payments, and you'll spend more than 25 years paying it off and shell out around $18,000 in interest alone. You'll hand the bank more than you borrowed. Meanwhile, if you try investing that $12,000 hoping for 10% annually, you're paying a guaranteed 24% to maybe earn 10%. That's volunteering to lose. Rule of thumb: anything over 6.7% gets eliminated before you invest. Cards at 24%? Gone. Personal loans at 16%? Destroyed. Federal student loans at 6.8%? Borderline, but I'd still lean payoff. Guaranteed returns beat hypothetical ones, and that interest compounds against you monthly like negative momentum while you sleep. I knew someone with $22,000 saved and $15,000 on credit cards at 23%. He believed investing early was everything, so he dropped $12,000 into index funds and kept paying minimums. 3 years later, the market was up 30%. His $12,000 became about $15,600. Sounds solid until you realize he paid nearly $10,000 in credit card interest during that span. His $3,600 gain cost him $10,000. He would have been thousands ahead just clearing the debt. No one had ever forced him to run the math. Once high-interest debt is gone, most people think the next move is invest every dollar. Not yet. The step people skip is the emergency fund. If you're single, renting, stable job, no dependents, 3 months of core expenses. If you've got a mortgage, kids, or freelance income, 6 months minimum. For most, that's $8,000 to $25,000. It feels boring. It feels like dead cash. It's not. It's insurance. Without it, when your car needs $1,500 in repairs and all your money's invested, you either sell investments at a bad time, swipe a 24% credit card, or ignore the problem. All panic-driven. An emergency fund earns peace of mind, and that's what keeps you invested when markets fall 30%. Park it in a high-yield savings account paying 3.5 to 4.5%. Not checking, not stocks. Boring. Safe. Debt cleared, emergency fund funded. Now maybe you've got $6,000 to $12,000 left. This is where real compounding begins. Priority 1, max a Roth IRA for 2026. Contribution limit likely $7,500 to $7,500. Check the IRS site. If you're under 50 and below income limits, contribute fully. This is one of the most powerful financial moves available. Growth inside a Roth IRA is tax-free forever. If you're 25 and invest $7,500 today at 10% annually, by 65, that single contribution grows to about $339,000, roughly $331,500 in gains, untaxed. In a taxable account, you might owe $50,000 to $65,000 in capital gains. You pay tax on the seed, not the tree. You fund the Roth with $7,500. Then what? Don't spiral into stock picking. Don't ask Reddit which company will 10x. Inside the Roth, buy a broad index fund. VOO tracks the S&P 500 with a 0.03% expense ratio. VTI tracks the total U.S. market at 0.03%. The S&P 500 has averaged about 10% annually for a century. Over any 20-year stretch, it hasn't delivered a negative real return. You're not discovering the next Apple at midnight. Insiders and competitors do that, and insider trading is illegal. Everyone else guesses. Buy the index. Let 500 companies compete for you. You can add 20% international exposure with VXUS if you want diversification. After maxing the Roth, open a taxable brokerage at Fidelity, Schwab, or Vanguard. Invest in the same funds. Automate monthly contributions. Remember, with index funds, you're buying a system. When you buy VOO, you're betting the U.S. economy continues evolving. Companies fail, industries collapse, the market historically recovers and makes new highs. Here's compounding in numbers. Invest $25,000 at 10%. In 10 years, about $64,843. In 20 years, roughly $168,637. In 30 years, around $436,236. You turn $25,000 into nearly $440,000 by leaving it alone. Add $600 per month for 30 years at 10%, and you're over $1.8 million. You might contribute around $241,000 total. The gains exceed $1.5 million. At a 4% withdrawal rate, $1.8 million throws off about $72,000 annually without touching principal. That's a salary generated by discipline. Delay costs more than you think. Invest $25,000 today for 30 years at 10%, about $436,236. Wait 5 years and invest for 25 years, you end with roughly $270,868. That 5-year hesitation costs you over $165,000. That's years of working life gone. Procrastination steals time, not just money. When people see those numbers, they hunt for ways to juice returns. That's where damage happens. The market sits near all-time highs most of the time because it trends upward. If you only invest when it's not at highs, you'll sit out most years. There's a famous study, the worst market timer imaginable, someone who invested $2,000 per year into the S&P 500, but only right before major crashes from 1970 to 2013, still ended with over $1.1 million. Why? They stayed invested. Time in the market beats timing the market. JP Morgan found that $10,000 invested from 1993 to 2013 grew to about $97,700. Miss just the 10 best days and you'd have about $49,000. 10 days out of roughly 5,000 cut returns in half. The best days cluster around the worst days. Sit out the panic, miss the rebound. Don't day trade. Roughly 90% of day traders lose money. The average active trader underperforms the index by about 6.5% annually. Don't buy what you don't understand. Whole life pitched as an investment? Run. MLM? Faster. Random crypto tip? Ignore. In a market that rises over time, you must work hard to lose money, yet 90% manage it. The silent killer is lifestyle inflation. You hit $25,000 and decide you deserve better. Maybe you do, but if that purchase resets you to zero, you burned years of effort in weeks. Credit card debt recently hit $1.28 trillion. The personal savings rate fell from 33% to roughly 3.5%. That's roughly $250 monthly saved by the average person. $250 a month invested for 30 years at 10% becomes about $566,000. Instead, most people choose a short-term upgrade. Imagine you've been driving a 2015 Civic for 7 years. It works fine, but you feel embarrassed. So you upgrade to a 2024 model. Payment, $420 per month. That's $5,040 annually. Invest $420 monthly at 10% for 30 years, and you'd have roughly $950,000. You traded a shinier car for nearly $1 million in retirement wealth. Same with upgrading apartments by $450 monthly. That's potentially another $900,000 over 3 decades. Spending $5,000 on a vacation because I deserve it might be emotionally true, but it could be 20% of your net worth disappearing for temporary dopamine. If you need short-term safety, treasury bills are an option. Backed by the U.S. government, rates locked for the term, often exempt from state and local taxes, ideal for money needed within 1 to 2 years. Real estate is another path. With $25,000, you could make a 3.5% FHA down payment on a $220,000 property, around $7,700 down, plus closing costs totaling $18,000 to $25,000. House hack a duplex, rent one unit, offset your mortgage, build equity. More work than index funds, but leverage can amplify returns. Age shapes allocation. In your 20s, be aggressive. 90% stocks, 10% bonds. Time is your edge. A 25-year-old investing $25,000 once at 10% could see about $436,000 by 55.